Hi and welcome to Crypto Cash Army. I'm Captain Crypto. Today's video is by far the most important video we've ever done on this channel. As we all know, the crypto market offers us opportunities to make large sums of money in very short periods of time. And of course, the chance to lose a lot of money as well. With all the money being made in the crypto space though, many crypto investors still tend to overlook taxes until it's too late, or they try to wait until the very last minute to start learning and preparing, which means they have little or no understanding of how crypto taxes really work and how they might impact their own personal situation. Well, with this video, I'm doing my best to address and correct this if I can. This video is my attempt to provide the most in-depth and comprehensive crypto tax information on YouTube. And to that end, I believe I have been successful, but I will leave that determination to you. Still, after countless hours of research and preparation, this video does aim to provide all the information that any retail investor in crypto would need to make good tax-related crypto decisions and figure out where he or she stands from a tax liability standpoint. I need to say that this video is very, very long, and that's not only unavoidable, it's by design. I did contemplate breaking this information and content up into more bite-sized pieces. Still, I ultimately decided that keeping it in one relatively easy to navigate video made a lot more sense because it would help prevent viewers from missing out on information in this video that is often intertwined or connected throughout different aspects of crypto taxes. To make it easier for you to find your way in the video, though, I have added numerous timestamps. These timestamps will help you find any specific crypto tax information you may be looking for. However, I do strongly suggest that you attempt to watch the video in its entirety, even if you have to come back a few times and watch it in several sessions. The information contained in this video could literally, and I do mean literally, save you hundreds or even thousands of dollars in taxes, and is something that absolutely every crypto investor needs to know. Before we go any further, I'd like to take a few seconds to say thank you to everyone that is supporting the channel. If you're not already a subscriber, please do subscribe and smash that like button. Again, thank you so much for being here. Let's get into the video. Hi, and welcome back. Before we do anything else, I need to go over Captain Crypto's disclaimer. I am not a financial advisor, nor am I a professional tax advocate or advisor. Hence, nothing at all, and I mean nothing, that is stated or referred to in this video should be considered financial or tax advice in any way whatsoever. And although I have made every effort to ensure the accuracy of the information in this video, you should always do your own research and or consult a licensed or registered financial or tax professional. Now, let's go over what we're going to cover in this video a little bit. The information in this video is intended for individual crypto investors only. And this video doesn't really pertain to commercial investing or running a crypto mining business, although we may cover crypto mining tax issues a little bit. Tax implications for businesses and companies are usually considerably different than those as they relate to individual investors. So if your business is directly related to mining crypto or commercial crypto investing, you should really seek some advice from a qualified CPA or business tax professional. Also, information in this video is specifically intended for U.S. citizens and U.S.-based investors only. So some of the rules, rates, and other information mentioned in this video may or may not apply to you if you live in another country. So we all know that in crypto you can make a lot of money. And of course, the tax man, Uncle Sam, he wants his cut. And he gets that in the form of taxes. So what exactly are crypto taxes? Well, the IRS, or the Internal Revenue Service, collects taxes on cryptocurrency related events that result in a realized gain in asset value or profit. And depending on how a digital asset or crypto is obtained, the IRS may classify your crypto holdings and transactions as regular ordinary income, interest income, or capital gains, or increases in the coin or asset's value. So, as it relates to crypto, what is taxable? What events are taxable? Well, in this section, we're going to discuss 12 crypto-related events that are taxable, or those transactions or events that are subject to taxation. We will also discuss how a particular event or transaction may be classified by the IRS and how that classification affects the type of tax you must pay. The first one is selling your crypto for profit. And this is probably the most basic, of course. If you sell your crypto at a profit, of course, the IRS wants taxes on that. Whenever you sell your crypto for a profit or sell for a higher price than you paid, that's a taxable event. Whatever profit or gain you earn from the sale of crypto is treated as a capital gain. The IRS treats capital gains in two different ways, and we'll cover those now. So what are capital gains? As it relates to taxes, a capital gain is a profit or increase in value of property that is realized through a sale or exchange for something of value. Now, property that is usually subject to capital gains taxes includes real estate, homes, buildings, jewelry, and of course, cryptocurrency. So, how are capital gains taxed? Well, first, it's important to note that capital gains taxes are paid only after an asset is sold and profit or gain is realized. So until you sell your crypto asset, you don't owe any taxes on it. The amount of capital gains tax paid pursuant to a crypto sale depends on how long you hold the cryptocurrency before you sell it. Therefore, the IRS taxes crypto sales differently for long-term gains versus short-term gains. And we'll discuss that now. Short-term capital gains taxes. Profits that you make from sales of cryptocurrencies that were owned or that you owned for 1 year or less, exactly 365 days, are generally treated for tax purposes anyway as ordinary income, the same as your wages or salary. Therefore, if you own and hold a coin for 1 year or less, you would pay taxes for the sale of that coin at the same income tax rate you would normally pay, which is, of course, based on your income level and tax bracket. And of course, these typically range from about 0% if you don't have a lot of income to as high as about 37%. And that's for the 2020 tax year. Of course, that'll go up a little bit for the 2021 tax year, but probably not a lot. You should also note that short-term capital gains also apply to crypto trading, for example, swing or day trading, and even bot trading. So every trade you make, even if it's an automatic bot trade, if it results in a profit or an increase in value for your crypto, that trade is subject to capital gains. And of course, short-term trading like swing trading and day trading, those are all going to be short-term capital gains. Now here you can see I've displayed some federal income tax brackets for 2021. And this will just give you an idea of how much your short-term capital gains would be taxed at, depending on your income tax bracket. If you're single and earn under about $10,000 a year, your short-term capital gains tax would only be about 10%. But if you're married and earn more than, say, $628,000 a year, your short-term capital gains tax rate would be much, much higher at 37%. So that's the way it works for short-term capital gains. They're taxed at your normal income tax rate. Now, of course, your standard deductions will decrease that standard income level, which does affect your short-term capital gains rate by reducing your total income just a little bit. Let's look at an example of a short-term capital gains tax as it relates to crypto. So John, he buys half of a Bitcoin, and when he bought his BTC, the purchase price was $10,000 per Bitcoin. So John, of course, he bought half a Bitcoin, so he paid $5,000 for it. A month later, John sold all of that Bitcoin when the price reached $14,000 per Bitcoin. So John realized a profit of $2,000. Half a Bitcoin times 14,000 minus 5,000 equals 2,000. John is single and he has taxable income from all sources, including the profit he made from selling the Bitcoin, and of course, minus all allowable deductions and exemptions of $50,000. Therefore, John falls into the 22% tax bracket, which we saw earlier in that table. So John would need to pay $11,000 in total for income tax to the IRS. Of that $11,000, John must pay the IRS. Tax on the sale of John's Bitcoin amounts to $440. This is because the profit from John's Bitcoin sale only amounts to $2,000 of the $50,000 of his taxable income. That was reported on John's 1040 tax form. So $2,000 times 22% equals $440. So John's net profit on the BTC sale after taxes is $1,560. So I hope you're with me so far. Since John held his Bitcoin for less than a year, he only held it for a month, he had to pay short-term capital gains on his profit of $2,000, which for his income tax bracket was 22%. And of course, you saw that the 22% of the $2,000 profit was $440. Let's move on. Next, we have long-term capital gains taxes. And these are profits or gains from the sales or trades of cryptocurrencies that are owned longer than 1 year. And these are generally treated for tax purposes as capital gains that are taxed according to a graduating scale or graduating thresholds. Capital gains tax rates are based on your total income amount, and they vary between 0% and 20%. So in short, the more you earn from all sources of income, the higher the amount capital gains taxes you will need to pay on the profit of your crypto sales. It's also important to note that many states tax capital gains as well. So in addition to paying capital gains taxes at the federal level, you may also have to pay capital gains taxes when you file your state income tax return. So here I've got a table that shows the amount of income where the thresholds or the different levels change. So you can see that if you're single, you can earn up to $40,000 a year from all sources and not pay any long-term capital gains rates. But if you earn over $445,000, you'd need to pay 20%. But even 20% for someone that earns about $450,000 is considerably less than his normal income tax bracket level, which is probably 35% or thereabouts. So holding your crypto long term obviously has tax benefit, especially if you have a moderately high income or if you have a very high income. So now let's take a look at a long-term capital tax gain as it relates to crypto. So Jim buys one Bitcoin, and when he bought his Bitcoin, the purchase price was $10,000 per Bitcoin. So of course, Jim paid $10,000 for one BTC. 15 months later, though, Jim sells that BTC when the price reached $25,000 per Bitcoin. So Jim realized a profit of $15,000. $25,000 minus $10,000 equals his $15,000 profit. Now, Jim is married, files jointly with his wife, and has a taxable income from all sources, including his profit from selling BTC, and of course, minus all allowable deductions and exemptions of $100,000. Therefore, Jim falls into the 15% capital gains tax bracket. So, Jim must pay $2,250 in capital gains taxes on the profits from his sale of Bitcoin. $15,000 profit times 15% equals $2,250 in capital gains tax. Now, please note that capital gains are taxed separately from your ordinary income, and long-term capital gains cannot push you into a higher regular income tax bracket. So those first brackets we looked at that range from 0 to 37%, having capital gains cannot push you up into a higher bracket. For example, if you're in the 15% tax bracket, having capital gains, regardless of how much they are, cannot push you up into the 20 or the 22% regular income tax bracket. But they will push you into a higher capital gains tax rate or tax bracket because your total income increases. So if your normal, regular, ordinary income places you at 15% in regular income tax brackets, that's not going to change. But if you get enough in capital gains, it may increase you from 0% up to 15% or from 15% up to 20%. And I hope that makes sense. We'll get into that a little bit more a little later in the video. Also, you need to know that your ordinary income is always taxed first. So the way the IRS calculates your taxes is it applies your income tax rate first, and then it starts applying capital gains taxes. Additionally, capital gains do increase your adjusted gross income, or your AGI. And this might cause you to become or be ineligible or not qualify for certain credits and deductions. But again, it doesn't increase your normal income tax percentage rate. Converting your crypto. Converting or trading your crypto for a different type of cryptocurrency. Switching, trading between currencies. This is also taxable. Even if you don't sell it for cash or USDT or a stable coin, it's still taxable. If you buy crypto and then convert it or trade that cryptocurrency into or for another cryptocurrency, you're subject to capital gains taxes. If the value of the original crypto increases before you make the trade or conversion. If that sounds a little bit confusing, we're going to look at an example so it'll be a little bit clearer. George bought 5 Bitcoin at $5,000 each, for a total initial BTC investment of $25,000. 2 months later, the BTC price increased to $10,000 per Bitcoin, and George traded all 5 BTC for 20 Ethereum coins that were selling for $2,500 each at the time of the trade. The total value of all 5 BTC at the time of the Ethereum trade was $50,000 because 5 Bitcoins had increased in price to $10,000 each. And the total value of the 20 newly acquired ETH tokens was also $50,000. 20 times $2,500 each. Since the price of BTC at the time of trade was higher than the original cost basis, and that's a word you're going to hear a lot in this video, cost basis, not just simply means the purchase price, George must pay capital gains tax on the trade. Purchasing 20 ETH tokens at $2,500 each resulted in a $25,000 gain in value, or profit, if you will, from the time of the original BTC purchase. Hence, capital gains tax is due. He sold 5 Bitcoin at $10,000 minus $25,000, which was his initial investment, equals $25,000 profit or capital gain. Now I said sold, but he traded them for Ethereum, which has the same effect and which is essentially the same in this case. It's the same as if he would have sold it for US dollars or US dollar tokens and then turned right around and bought the Ethereum. But as you may or may not know, on many exchanges, you can convert Bitcoin directly to Ethereum and vice versa. In this case, normal short-term capital gains rates apply to the BTC purchase and disposition. In this case, just as I mentioned a little earlier, trading the BTC directly for the ETH had the same tax effect as just selling the BTC and then buying ETH tokens. And any subsequent increase in the price or value of ETH after the date of the BTC ETH trade would also be subject to capital gains taxes should George sell or trade his 20 Ethereum tokens. Now let's take a look at that same example again, except this time I'm going to break it down a little more. So of course, George buys 5 Bitcoin at $5,000 each. 5 Bitcoin times $5,000 equals $25,000 cost basis. And there's that word again, cost basis, which just, like I mentioned earlier, means purchase price. So 2 months later, the Bitcoin price increases to $10,000 per coin. George then proceeds to trade all 5 of his Bitcoin for 20 Ethereum, which have the same total value of $50,000. So as you can see, 5 Bitcoin times $10,000 equals $50,000, and 20 ETH worth $50,000 equals $2,500 per coin. So the capital gain or profit from the time of the initial BTC purchase is $25,000. 20 ETH times 2,500 equals 50,000 minus the original $25,000 Bitcoin cost basis equals $25,000. For the current tax year, George's total adjusted income places him in the 22% tax bracket. Since short-term capital gains are taxed the same as wages or income, George's capital gains tax obligation for the trade also amounts to 22% of the profit or capital gain, which in this case would make his liability for the trade $5,500. Now, if he had other capital losses, he could offset or reduce the amount of tax that he owes. But we'll talk about that a little later. Now, this one is one that a lot of people don't understand, or they really don't pay attention to. And it can be a trap, a tax trap, if you're not careful, depending on how much you use crypto to make purchases. So making purchases with crypto. Generally speaking, purchases made with crypto are taxed in the same manner as the trading conversion transaction types we talked about in the previous section. So in short, if the value of the crypto has went up since you bought it initially, a purchase with that same cryptocurrency triggers a taxable event subject to short or long-term capital gains taxes. Let's take a look at an example. Say Linda purchased 100 Harmony 1 tokens for $1 each and holds them for about 18 months before deciding to use them to make a purchase at an online store that accepts crypto and accepts Harmony 1. At the time of the online purchase, the value of the one tokens had increased to $2 per coin. So then Linda used all 100 of her Harmony One tokens to pay for a dress that cost $200. Since the cost basis of the 101 tokens was only $100, the purchase of the $200 dress meant that the value of the tokens had increased and resulted in a $100 profit or capital gain. Because Linda had held the one coins for longer than a year, though, and because her adjusted gross income for the tax year was $50,000, she would be subject to a 15% capital gains tax on the profit of the Harmony One tokens at the time of the online purchase. So her capital gains tax for the transaction in total would be $15. Because she bought the Harmony One tokens at $1 each, which meant a total cost basis or purchase price of $100. Hope you're with me so far. Then, of course, the fair market value or price for Harmony One increased to $2 per coin when she proceeded to use all 100 of them to pay for a $200 dress. So, meaning she technically had a $100 capital gain or profit, if you will. And 15% of that $100 is, of course, $15. Now, that might sound trivial, but you need to report that. And if you make a lot of purchases with crypto, you should be keeping track of the date and time you sold them and how much your crypto was worth when you made the purchase. Now let's move on. Next one is one that we're starting to see more and more of. And of course, that's people receiving their salary or pay in crypto. If you receive some or all of your wages or salary in crypto, then you must report it as normal wage income, just like you would regularly. Nothing really changes in that regard. Additionally, you should always receive a W-2 even if you receive crypto, just like you would if you received a normal paycheck or a direct deposit. Your employer has to provide you with a W-2. Now, after receiving that crypto for your salary or wages or whatever you want to call it, if you continue to hold that crypto and do not sell or convert it to fiat or dollars, then it will be subject to capital gains taxes when you finally do choose to sell, if that crypto goes up in value. And your cost basis would be how much the crypto was worth as it pertained to your salary. So if you received 0.01 Bitcoin and that was for $200 salary, that's how much you are deemed to have paid for the Bitcoin, $200. And of course, any appreciation or depreciation would result in capital gains or capital losses. And just like we talked about in the sections leading up to that. Here's another one many people don't think about or don't consider when they do their taxes. And this is selling goods or services for crypto. And this pertains mostly to small businesses, but I thought I'd throw it in here because, if you do run an eBay business or sell things online and accept Bitcoin or Litecoin or anything else, then you should definitely be aware of this. If your business sells goods or services and you accept cryptocurrency as payment, then any crypto you receive must be reported as regular business income. Just like we mentioned, people need to report their crypto they receive as salary as normal income. If you have a business and you accept crypto, you need to report it as normal business income as well. And again, if you do not sell the crypto or otherwise convert it to fiat or another coin, and the crypto prices increase after you receive it from your customer, you will be subject to capital gains taxes when you finally do sell, if the price goes up. Now, if the price goes down, you can claim a capital loss. Here's a big one. And a lot of people get confused by this because, anyway, let's talk about it. Receiving crypto as a gift. Generally speaking, if someone gives you crypto as a gift, you will not owe any taxes at all until you sell or convert it to another type of cryptocurrency. When you do sell the crypto, you may be subject to capital gains taxes, especially if you do not know how long the person who gave you the crypto had held it or how much he or she paid for it. To give you a better understanding of this, let's take a little deeper look and then review a few different scenarios to help determine when you would or would not owe capital gains tax on crypto you receive as a gift. If you receive crypto as a gift, it's always a really good idea to ask the person who gave the gift to document it or provide you with a letter or some documentation with information such as the purchase date and the amount paid. Having this information is essential in minimizing any capital gains tax liabilities you might incur. If you do not have this information available, then you will probably have to pay capital gains tax on the entire amount of the trade when you convert to fiat or another cryptocurrency. And that's because your cost basis is essentially zero. If you can't document how much the original owner paid, then it's zero. If you know the date when the person who gave you the crypto purchased the asset, the IRS does allow you to adopt his or her holding period. This means you may be eligible to take advantage of preferential long-term capital gain rates sooner or maybe even right away. If the person who gave you the crypto had held it for more than a year. But even though he or she didn't hold it for more than a year, you'll still be able to take advantage of long-term capital gains rates sooner than you would if you didn't have the information. So even if they had only held it for a couple of months, you would only need to hold it like another 10 months before selling it instead of holding it for a little over a year. If you know the amount the giver paid for the gifted cryptocurrency, you may be able to adopt his or her cost basis. Whether you can claim the giver's cost basis depends on if you have a gain or a loss when you convert the crypto to cash or another cryptocurrency. So let's look at a few examples. So we're going to look at 3 different scenarios where you might receive crypto as a gift. Before we do that, though, you should know that if you don't know and can't document the price paid by the person who gave you the coin or coins, your cost basis will be zero. This means that whatever you sell the crypto for, you will owe capital gains tax on the entire amount of the sale. That's ouch. With that in mind, let's take a look at 3 possible tax scenarios for gifted crypto when you do know the cost basis and purchase date, and again can document the information. Those 3 tax scenarios are: proceeds from the sale or trade are higher than the giver's cost basis. Proceeds from the sale or trade are less than the giver's cost basis and less than the fair market value, or FMV, at time of gift. Proceeds from the sale or trade are less than the giver's cost basis and more than FMV at time of gift. Now, let's look at each scenario in a little more detail. Scenario number 1, proceeds from the sale or trade are higher than giver's cost basis. So this means that when you sell the crypto or convert it to another cryptocurrency, the proceeds or the value of the new coins are higher than what the person who gave it to you paid. Linda receives 1 Bitcoin as a gift from her father, who had held the coin for about 2 years before giving it to her, and he does provide the documentation. When Linda's father purchased the Bitcoin, the price was $10,000 each. After receiving the BTC, though, Linda decides to sell it and use the proceeds for a major purchase. She sold the Bitcoin for $50,000. Pretty good deal for Linda. So in this case, Linda's cost basis is the same as the price paid by her father, $10,000. Linda's holding period is also the same, longer than 1 year, even though she sold the Bitcoin immediately after receiving it. That's because her father had held it for 2 years and was able to document it. Linda's BTC sale qualifies as a long-term capital gain, again because her father held it for 2 years. Linda's adjusted gross income level places her in the 15% capital gains rate bracket. Linda's profit or capital gain on the sale is $40,000. She sold it for $50,000. Her father paid $10,000. So her profit is $40,000. Linda must pay $6,000 in capital gains taxes on the sale of the one Bitcoin. $40,000 times 15% capital gains tax rate equals $6,000. The fair market value at the time of the sale is irrelevant because her father's cost basis was lower than the sale amount. Even though the sale of the BTC increased Linda's total adjusted gross income by $40,000, it did not increase her income tax percentage. Remember, ordinary income and capital gains are taxed separately, with ordinary income being taxed first. So let's move on. Scenario number 2. Proceeds from the sale or trade are less than the giver's cost basis and less than fair market value at the time of gift. This means that when you sell or trade the gifted crypto, you sell it at a price that is less than the giver's purchase price and less than the price of when the gift was given to you. In this example, John receives 10 Litecoin as a gift from his sister, who had held the coin for about 2 months before giving them to him. When John's sister purchased the LTC, the price was $200 per coin. At the time John received the gift, the price was $175. A month after receiving the gift, John decides to sell all the Litecoin and use the proceeds to pay some bills. John sold the Litecoin for $150 per coin. So, John is in a loss position because he sold at a price lower than what his sister paid for it and lower than what it was worth when his sister gave it to him. The total holding period for the LTC is less than 1 year, which is irrelevant because the sale of the LTC resulted in a capital loss. John's cost basis is limited to the fair market value of Litecoin, $175, at the time of the gift because it was less than his sister's cost basis at the time of the gift. Even though John must use the fair market value as his cost basis for the LTC, he still ends up with a loss of $250. 10 times the fair market value of $175, which was the price when his sister gave it to him, equals $1,750, minus the sale price, how much John sold it for, 10 times $150 equals $1,500. So $1,750 minus $1,500 equals a loss of $250. John can use the capital loss to offset any other taxes he may owe. So if he winds up owing taxes on income or something else, he can use that $250 capital loss to reduce his tax burden a little bit. The same capital loss would apply if he had converted the LTC to another cryptocurrency, as long as the total value of the new coin holding was lower than the fair market value at the time of the gift from his sister. So instead of selling it, if he had converted the LTC to Bitcoin and it was still only worth $1,500, he could have still claimed a $250 capital loss. Let's go to the next one. Gift tax scenario 3. Proceeds from the sale or trade are less than the giver's cost basis and more than the fair market value at time of gift. James receives 10 Ethereum as a gift from his friend, who had held the coin for a little over 1 year before giving it to him. When James's friend purchased the ETH, the price was $300 per coin. At the time James received the gift, the ETH token price was $200. A month after receiving the gift, James decided to sell all the Ethereum and use the proceeds to help with a down payment on a new car. James sold all 10 ETH coins for $2,500 or $250 per coin. So, of course, James assumes his friend's holding period, which is longer than 1 year. Therefore, James is eligible to claim the preferential or usually lower long-term capital gains rate. James cannot, however, use his friend's cost basis because it would result in a capital loss. So John must use the fair market value of the ETH at the time of the gift because it is higher than his friend's cost basis. James sells all his ETH for a profit based on the fair market value at the time of the gift. And at the time of the gift, the fair market value was $200 per coin. So he sold it for $250 equals $2,500 minus the fair market value of $2,000, or 200 times 10, meaning he wound up with a $500 profit, even though his friend paid $3,000 for it. James must pay long-term capital gains tax on the $500 profit. Based on his AGI, or adjusted gross income, James' capital gains tax rate is 15%. So James must pay $75 in capital gains taxes for the sale of the ETH coins. Now let's move on to the next one. Let's talk about lending your crypto. If you lend your crypto on a DeFi exchange or otherwise contribute to a platform that supplies crypto loans, interest will likely be paid in kind. For example, if you lend ETH, your interest will be paid in ETH, at least on most DeFi exchanges. With any scenario, though, where you are lending crypto, you will be liable for taxes on any interest you earn. Crypto earned through lending is usually reported on Schedule B, or interest and ordinary dividends form, and attached to your regular income tax return. Most lending platforms pay interest earnings directly to your crypto balance in the same cryptocurrency. So if you are lending ETH, you would see your ETH wallet balance on the platform increase gradually over time. In this type of scenario, you would claim the coins earned as ordinary income, like income earned from your salary, except it would be interest income, of course. Of course, if you continue to hold the newly earned coins, you would be liable for capital gains tax if they appreciate in price and you then sell them. If the platform issues their own tokens when you lend crypto, the rules do change a little bit. So let's discuss those now. Some newer DeFi platforms issue their own LPT, or liquidity pool tokens, when you lend by providing liquidity for certain cryptocurrencies. When you provide liquidity, you're essentially providing the coins that the exchange needs to facilitate transactions and loans and purchases and everything that the DeFi exchange does. But when you provide liquidity and receive LPTs in return, this essentially creates a trade or token swap. So in these cases, the value of your LPTs increases, but the quantity in your native cryptocurrency wallet remains the same. So when you provide these types of loans to DeFi exchanges and they issue liquidity pool tokens, those tokens will increase in number, but your native cryptocurrency will stay the same. When you later convert your LPTs back to the original crypto asset, you are essentially just trading the LPTs for the crypto for which you provided liquidity. For example, you go from ETH to LPTs, then back to ETH. Hence, you are creating a taxable event subject to capital gains tax. So in this instance, any interest received from providing liquidity is taxed as if it were a capital gain from a sale or conversion and is subject to the corresponding short or long-term capital gains rules and rates. So to review real quick for lending, if you provide loans or help supply loans on certain exchanges, you may receive interest in your native crypto or the coin or currency you're lending. And in that case, you would have to report that income as interest income or ordinary income. But when you provide liquidity on a DeFi platform and they issue a separate or different type of token, and that balance increases over time, then when you swap them back to your native cryptocurrency, then any gains you realize would have to be reported as capital gains. So let's continue. Some DeFi platforms like Balancer, Compound, and Yearn.finance, they distributed governance and or incentive tokens for activity on their platforms. And these types of platforms are becoming really popular with investors because of the income that can be earned through yield farming or liquidity mining. So if you receive these types of tokens, they are taxed as ordinary income at their current market value. So when you do receive these types of tokens on certain DeFi exchanges, as soon as you receive them, they're reported as regular, ordinary, or interest income. Of course, when you sell those tokens, if they have increased or decreased in value, then you would need to report a capital gain or a capital loss, just as is the case with normal crypto lending. For instance, if you receive one balance token worth $100, you would owe regular income tax on that $100. If you later sold the token for $200, you would owe capital gains tax on the $100 profit. Mining crypto. If you follow the crypto market, especially this year, you've probably heard how profitable mining can be when prices are high for popular proof of work cryptocurrencies like Bitcoin and Ethereum. However, if you do participate in mining, it's important to note that all crypto mined and sent to a wallet is taxable. Crypto that you earn through mining is taxed as regular income at the fair market value on the date you collected or added the crypto to your wallet. So when you're mining, if you don't actually take possession of the crypto right away and you have it, say, in a liquidity pool or something, or it's actually stored somewhere else before you receive it, then you don't have to pay any tax, or you don't owe any tax on it until you actually receive it in your own wallet or a wallet that you control. Now, if when you sell or convert the mined crypto and the price has increased, of course, you must claim the value increase as capital gains. And normal holding periods for claiming short or long-term capital gains rates apply. Let's go to the next one. Crypto staking rewards. Staking is a great way to earn passive income with your crypto while also helping to increase security and process transactions on the blockchains you support. Staking essentially just lets you earn free crypto 24 hours a day around the clock with virtually no effort once you stake it. However, those juicy staking rewards are taxable. Crypto earned through staking is taxed as ordinary interest income once you collect your staking rewards. You must claim the FMV of the or fair market value of the coins on the day collected as ordinary income. If you hold and sell the new coins at an increased price later, you must declare the difference in the original fair market value and sell price as capital gains. Crypto earned through staking is usually reported on Schedule B, just like lending, interest, and ordinary dividends. And you attach that to your regular income tax return. Please note that you're only liable for income tax on staking rewards if you claim them and add them to your wallet. So sometimes it can be advantageous just to leave them at the staking pool until it's advantageous from a tax standpoint for you to collect them. For example, if your income is already pretty high this year and you have quite a few staking rewards waiting for you to claim, it might help just to wait until next year to claim them, or wait till a low income year to claim them. If you leave them on the staking pool, you have not yet realized any sort of income until you actually take possession of it. So, in short, if you don't claim them, you don't owe any income tax on them yet because you don't actually have control of them. Airdrops. Now, this is a big one because nobody asks for an airdrop. Usually it just happens. So sometimes coins just show up out of nowhere, it seems. When the projects running the cryptocurrencies, they send out airdrops and give everybody that meets certain criteria, essentially just free crypto that just falls from the sky into your wallet. And while this is not exactly how they work, airdrops, like I said, airdrops do give you free crypto, which means free money in most cases. If you've received an airdrop, you must declare the fair market value of the free coins as regular income on your tax return. You must declare any coins received in an airdrop as ordinary income, even if you don't sell them. The fair market value declared is generally for the date you received the airdrop. So whatever the price is for the crypto on the day you receive the airdrop, that's your fair market value. Now, generally speaking, of course, crypto prices change second by second, but if you just figure the average price for the day, that should be fine for calculating your fair market value or cost basis for airdropped coins. If you continue to hold the free coins and sell them at a higher price than they were on the day that you received the airdrop, that is, you must declare the difference between the sale price and the initial FMV as capital gains. So I guess that should be pretty straightforward, I think. Up to now, we've been covering a lot of things that are taxable. So now we're going to talk about crypto-related events that are not taxable. So, what is not taxable? Well, in this section, we're going to discuss 5 crypto-related events that are treated as non-taxable, or those transactions or events that are not subject to taxation by the IRS. It is important to note, however, that there are a few exceptions, so we will try to cover those as well. Buying crypto. The act of simply purchasing crypto is generally not a taxable event, especially if you purchase cryptocurrency with a credit card or with funds sent from your bank account. Also, if you must first purchase an intermediary coin to make the purchase, for example, the coin you want to purchase is only available as a BTC / the coin you want to buy pair. That intermediary coin purchase or conversion is not a taxable event as long as the intermediary coin, in this case BTC, has not appreciated in price since the time of its purchase. So if the coin you want to buy cannot be purchased with USDT or with fiat, and you can only buy it with BTC, if you buy BTC first, then immediately exchange it for the second coin, chances are you won't have to pay any type of capital gains tax because it's the same day and BTC didn't technically go up in value. Let's talk a little bit more about that though. For instance, this would apply if you want to purchase coin ZZZ, but it is only available as a BTC ZZZ pair. And there is no way to purchase the ZZZ coin with a stable coin or USD. In this case, of course, like I mentioned, you must first purchase BTC and then use the Bitcoin to purchase the ZZZ token. As long as you use the BTC to purchase the ZZZ token immediately, capital gain or loss is negligible or non-existent. So let's move on. Holding or hodling crypto. Holding or keeping cryptocurrency in a wallet is never a taxable event. That is, unless you use your wallet balance to earn interest, i.e. staking. Then any staking rewards you would earn would be subject to taxation. Or if your wallet address receives an airdrop of free crypto, which we also covered. Nevertheless, as long as your crypto just remains in your wallet, it's not taxable, even if it remains in the wallet for many, many years. Selling personal stuff for crypto. If you sell household items, cars, or other items that depreciate over time, you usually won't have any tax liability at the time of the sale if you sell them for less than you paid for them, even if you receive crypto instead of cash. If you sell items for more than you pay for them, you will be liable for capital gains taxes, just as you would if you received cash, a check, etc. In this situation, investment sale and short or long-term capital gains rules apply. Additionally, if you hold the crypto after receiving it, you will be liable for capital gains if you then sell it after the crypto increases in price or value. The cost basis for your crypto would be the fair market value of the coin or coins on the date you made the sale. Transferring crypto between wallets. Just as simply holding crypto in your wallet is not a taxable event, neither is moving the cryptocurrency to another wallet you control. If you transfer the crypto to someone else, though, for settlement of a debt or payment for goods or services, you may be liable for capital gains taxes based on the fair market value of the crypto when you purchased or received it. And this also applies if you move crypto to an exchange wallet. So if you move crypto to Coinbase or KuCoin or Binance or wherever, as long as you don't sell it and you just move it to your wallet on that exchange, that's not taxable either. Gifting crypto to someone. Now, earlier we discussed receiving crypto as a gift. So now we're going to talk about giving crypto as a gift. Generally speaking, there are no tax consequences for just giving someone cryptocurrency as a gift. And in most cases, like we covered earlier, persons receiving the crypto gift are not liable for taxes until they sell or convert the gifted coins. However, there may be tax liabilities if you give more than $15,000 of cryptocurrency to a single person, meaning that you can give $15,000 or up to $15,000 to as many people as you want. But if you give more than $15,000 to a single person, you might have to pay tax on that, but probably not, because there's also a lifetime exemption of about $11 million and some change that you can claim as well for gifting. So anyway, let's take a look at how certain crypto gifts may or may not trigger tax liabilities. Let's look at an example. George buys half a Bitcoin for $2,500 on March 20th, 2019. On November 20, 2020, George gifts the 0.5 BTC to his girlfriend Paula. On the date of the gift, the 0.5 BTC had a value of $7,500. So, of course, the BTC had went up in value by $5,000. If George had sold the Bitcoin instead of giving it to his girlfriend, he would have realized a long-term capital gain of $5,000. However, because he gave the BTC as a gift to Paula, he is rewarded with some tax savings. As the person giving the BTC, George avoids having to pay any tax at all on the crypto. For George, the entire gift is tax-free, and it is as if he never purchased or sold or disposed of the Bitcoin at all. So it's simply like he had never had it. There are also benefits for Paula as well. Since George held the Bitcoin for more than a year before giving it to Paula, she can adopt his holding period and take advantage of preferential long-term capital gains rates, even if she decides to convert or sell the Bitcoin right away. She also adopted George's cost basis as well, so she won't have to report the cost as being zero. This is possible, of course, because George provided her with documentation showing the date of purchase as well as the price paid for the Bitcoin. And we did discuss this earlier in taxable events for crypto. And anyway, let's move on. Donating crypto to a charity. If you've had a really good year in crypto, or you maybe just earned more than usual in some other ways, donating crypto to a qualified charitable organization is a great way to reduce your tax burden. Also, more and more charitable organizations are starting to accept crypto as donations. So the chances are good that you'll be able to support your favorite charities even without having to give them cash. If you donate crypto you held for at least 1 year to a charity, you are eligible for an itemized charitable deduction for the fair market value of the cryptocurrency at the time of the donation. Additionally, you will not incur any taxable gain on an appreciated crypto asset. If you donate crypto you held for less than a year or exactly 1 year, you will still be able to claim an itemized deduction. However, you can only claim the cost basis for the crypto as a deduction and not the fair market value. Nevertheless, you will not incur any taxable gain if the coin or token appreciated or increased in value. Let's take a look at a couple of examples to better see how this works. Now, in our first example, this is an example of a long-term appreciated crypto asset, or a crypto asset that went up in value and it has been held for more than a year. Sheila bought 1 Bitcoin for $5,000 on June 1, 2019. On July 15, 2020, she donated 1 BTC to the Salvation Army when it was worth $10,000. If Sheila would have sold the Bitcoin for $10,000 rather than donating it, she would have incurred a $5,000 long-term capital gain and would have to pay taxes on the gain. Since she donated the BTC to a qualified charitable organization, though, she does not recognize any gain at all and is eligible to deduct the $10,000 fair market value in itemized charitable deductions. Now let's look at another example. And this one is an example of a short-term depreciated crypto asset when fair market value is less than cost basis. So in this case, the crypto went down in value and its current fair market value is less than the person paid for it, or in this case, Luke. Luke bought 10 Ethereum for $10,000 on March 1, 2021. Luke then donated all 10 ETH to the United Way on May 15, 2021, when it was worth $5,000. If he sells the ETH, he can claim a $5,000 capital loss. He could then take that $5,000 from the sale of the ETH and donate it to receive $5,000 charitable deduction, an itemized charitable deduction. If he were to just donate the crypto directly to the United Way, he would receive a $5,000 itemized charitable deduction, but he wouldn't be able to claim the $5,000 capital loss. By selling the ETH at $5,000 and then giving the cash to the United Way, he is able to reduce his tax burden by the full purchase amount of $10,000. $5,000 for an itemized deduction and $5,000 as a capital loss. So instead of just losing $5,000 by giving crypto away, selling it and giving them the cash allows him to essentially recover his entire investment in tax savings. Now let's go on. In our third example for donating crypto to a charity, we'll look at an example of a short-term appreciated crypto asset when the fair market value is greater than cost basis. So this is a crypto asset that's been held for less than a year, and its current fair market value or price is higher than when the person bought it, or in this case, Cindy. Cindy bought 10 Ethereum for $5,000 on February 1, 2021. Cindy then donated all 10 ETH to Save the Children on May 10, 2021, when it was worth $10,000. If she would have sold the ETH, she would incur a $5,000 capital gain and have to pay taxes on it. Since Cindy donated the ETH to Save the Children, she does not recognize any gain and is able to claim $5,000 in itemized charitable deductions. Take note that unlike the long-term appreciated crypto sample we just looked at it a couple of minutes ago, Cindy is only allowed to claim the cost basis of $5,000 as a deduction. If she would have waited until she had held the ETH for over a year before donating the crypto, she would have been able to claim the full $10,000 fair market value as a charitable deduction.
Drop and give me 20 push-ups right now, or like and subscribe. The choice is yours.
Now for some of the good stuff. How to save on crypto taxes. Up to this point, we've discussed primarily all the many ways the IRS can cut into your crypto profits. Nevertheless, there are many ways to reduce your tax burden that are completely legal and not too overly complicated. So in this section, we're going to discuss some of the ways you can reduce your crypto taxes, or at least how to defer them until times that are advantageous for you and not the IRS. The methods in this section are not only effective, they are relatively simple and straightforward. So make sure you take some notes. Let's get started. First of all, don't forget your crypto losses. I mean, it would be great if every crypto trade or purchase you made were profitable, but that's simply not the case, and we all know that. Losses do happen. However, from a tax-saving perspective, losses can help a lot. Generally speaking, losses related to investing in cryptocurrency are tax deductible, even if you can't always claim all losses in a single year. In some cases, you may have to spread your losses over time. Still, losses can be claimed to reduce taxes. With that in mind, let's take a look at a couple of examples of how losses can offset gains or reduce your tax liability. Crypto loss tax deductions. For tax purposes, the IRS treats cryptocurrencies like Bitcoin and Ethereum as property. This means that they are subject to capital gain and loss rules. This also means that if you realize capital losses with crypto, you can deduct those losses from any other capital gains you may have. When calculating total capital gains or losses, though, you must include all asset sales or conversions, not just your cryptocurrency transactions. For instance, if you sold real estate or real property, stock, or other capital assets, you must calculate totals for all of them. If you have a net capital gain, you cannot deduct capital losses from ordinary income, but you can use those losses to offset or reduce the amount of total capital gain. Sound confusing? Yeah, I know. So let's take a closer look. Let's take a look at our first example of capital loss deductions for crypto. Sam had a fairly good year in crypto. He had a few losses, but he also had some real winners. Sam sold 3 coins at a loss and had total capital losses of $5,500. But he also sold 3 other coins for profit and had total capital gains for those sales of $12,500. Sam doesn't have any other capital gains or losses from the sale or disposition of other capital assets, i.e., he didn't have any stock sales or he didn't sell a house or anything like that. Since Sam's capital gains are more than his capital losses, he can offset the total amount of the losses to reduce his gains. So, 12,500 capital gains minus $7,500 capital losses equals $5,000 capital gains. Therefore, Sam only pays capital gains on $5,000 instead of paying them on $12,500. Now let's go to our next example. In our second example, Martin had an absolute terrible year in crypto. After calculating all his winners and losers, he realized a net capital loss of $20,000 for his crypto investments. However, he also sold a house and had a very good year in the stock and precious metals markets. For all of his other capital assets, other than crypto that is, he had a net capital gain of $70,000. Because his net capital gain for his other non-crypto assets was higher than his crypto capital losses, he is able to deduct the entire $20,000 crypto loss from his other capital gains. So his total taxable capital gain is $50,000. $70,000 from his other assets minus the $20,000 loss in crypto equals a $50,000 total capital gain. Since he had held or owned all his other capital assets for more than a year, Martin is able to take advantage of long-term capital gains tax rates, which, as we discussed earlier, are much more advantageous than short-term rates. Now, in our third example, let's take a look at Kathy. Kathy is really big into day and swing trading on crypto. And while she had a few wins this year, she got wrecked on more than a few high leverage trades. After subtracting her losing trades from the profitable ones, Kathy wound up with a total loss of $15,000 for the current tax year. Because Kathy does not have a net capital gain, she cannot offset or deduct the entire amount of her loss this year. IRS rules limit the amount she can deduct from her taxes for the capital loss to $3,000 in a single tax year. However, she can carry the loss forward into future tax years and deduct $3,000 per year from her taxes until the entire loss has been deducted. If she has a capital gains before the entire loss amount has been deducted, she can use any remaining balance of that loss to offset the gains and reduce future capital gains taxes. So she's only able to deduct $3,000 this year, but if she has $12,000 in capital gains next year, she can still use that balance of a $12,000 capital loss to offset all of her capital gains. Note, if you have a net capital loss, you may be eligible for an increased tax refund if you paid more in taxes during the year than you owe. And this is because the $3,000 deduction will lower your adjusted gross income, which will in turn reduce the amount of income tax you have to pay, which in turn increases your refund if you're due one. Let's move on. Now let's talk a little bit about cost basis methods. Now, up to now, we've talked about that cost basis is actually how much paid for it. But as far as when you go to file your taxes, there are a few things about cost basis you need to know. So let's start with this. If you make only a few crypto transactions, keeping track of the cost basis for them is relatively straightforward. For instance, let's say you bought half a Bitcoin and then sold it a year later. You also bought 5 Ethereum and sold them a year later. In this case, calculating cost basis for each coin is simple, as it would simply be how much you paid for each of the 2 transactions. However, when you start entering into multiple crypto transactions, things can start to get a little tricky. Prior to 2019, the IRS allowed multiple cost basis assignment methods for crypto transactions, and these included first in, first out, last in, first out, highest cost, lowest cost, average cost, and specific identification. Since 2019, though, the IRS allows only 2 cost basis assignment methods: first in, first out, or FIFO, and specific identification. And we're going to discuss both of those in a little more detail. And since the IRS basically only allows 2 cost basis methods now, we're not even going to go over the rest because you don't need to know what they are. First in, first out cost basis. With current IRS regulations and rule, FIFO, or FIFO if you will, is one of 2 acceptable cost basis assignment methods. As its name implies, the FIFO method assumes that when you sell crypto, you are disposing of the asset in the order that it was purchased, meaning that when you start selling your crypto, you would sell the crypto that you bought first. Say, for instance, that you made 3 Bitcoin purchases. Each time you bought BTC, you purchased half a Bitcoin for a total of 1.5 BTC. The prices you paid in order were $5,000, $10,000, and $15,000 respectively. Later, you sold 1 BTC for $25,000. With the first in, first out method, you would have to use the cost basis for the first 2 purchases, as the first 2 buy transactions were made before the third and final purchase. Because you are using the FIFO cost basis method, your total cost basis for the 1 BTC you sold would be $15,000, which would result in a $10,000 profit or capital gain. Now let's take a look at the specific identification method and how it might affect your tax liability in this case. The specific identification cost basis. The second cost basis assignment method recognized by the IRS is the specific identification method. This method allows you to select specific assets to dispose of, regardless of the order in which they were purchased and sold. For instance, let's use the same data from the previous FIFO section. You made 3 BTC purchases. Each time you bought BTC, you purchased half a Bitcoin for a total of 1.5 Bitcoin. Again, the prices you paid in order were $5,000, $10,000, and $15,000 respectively. Later, you sold 1 BTC for $25,000. With specific identification, you can select the purchases with the highest cost basis to save on taxes. In this case, because you only sold 1 Bitcoin, you can select the last 2 purchases as your cost basis, which means your total cost basis would be $25,000. Of course, this means your net capital gain would be 0 and result in no capital gains tax being owed. Let's talk a little bit more about cost basis methods. You are free to choose either the FIFO or the specific identification cost basis method when doing your taxes. However, you can only use one method for a given tax year. So if you enter some sales or trades using the FIFO method, you must use that method for all your crypto trades. The same applies if you choose the specific identification method. You can only use it. If you bought more crypto than you sold, the specific identification method may work best in helping you increase your cost basis and reduce your capital gains tax liabilities. If you sell all of a given crypto asset during the tax year, i.e., you sold all of your Ethereum, your cost basis would simply be the total amount paid for all the ETH tokens you sold. You can include certain transaction fees in your cost basis as well, and we will cover that in the next section. Other crypto tax deductions. Besides capital losses, there are not really any other expenses that you can claim as crypto-related deductions as an individual. You can, though, claim any tax service or software used to calculate your crypto taxes and as an expense if you itemize your deductions. Prior to the Tax Cuts and Jobs Act, or the TCJA, certain investment-related expenses were allowable if you itemized expenses. For tax years 2018 to 2025, though, these deductions are no longer allowed. These disallowed deductions now also include transaction fees. However, you can still save a little money on your taxes by adding your crypto transaction fees into the acquisition or disposition cost of your crypto purchases or trades. Let's take a look at how that works. Crypto transaction fees and cost basis. So let's say that Paul buys $10,000 worth of Ethereum and pays $500 in gas and transaction fees. In this case, the IRS would allow Paul to add the $500 in fees to the cost of the actual Ethereum purchase. So his total cost basis for that batch of Ethereum would be $10,500. Simple enough, right? Just add the fees to your coin purchase or trade cost to get your total cost basis. Now, let's say that a few months later, Paul sells that Ethereum for $11,000 and again pays $500 in fees, which we all know with Ethereum is possible. In this case, the IRS also allows Paul to deduct the fees from the total sale price. Therefore, instead of a $1,000 profit, Paul only claims a capital gain of $500. $11,000 sale price minus $10,000 purchase price minus $500 in sales transaction fees equals a $500 capital gain. Now, in the above example, I did not include the transaction fees for the initial purchase, which were also $500 and which can also be added to the cost basis. Now, if I do include both the buying and selling transaction fees, the capital gain or loss would be zero. $11,000 sale price minus $10,000 purchase price minus $500 sales transaction fees minus $500 purchase transaction fees equals $0 capital gain. No taxes are due on the transactions because after everything, Paul just breaks even on the deal. So while you cannot claim transaction fees as itemized deductions, they can be used to increase your cost basis, which saves you money on capital gains taxes. Now I want to talk about wash sales real fast. And if you don't know what a wash sale is, that's okay, because I'm about to tell you. I want to also tell you how they can save you a lot of money in crypto, at least for now. The crypto market, as we all know, can be extremely volatile, and assets that are profitable one day can be deep in negative territory the next. And while losses are indeed painful, they do represent excellent opportunities to save a lot of money on your taxes, especially if you also have a few big winners. In fact, intentionally selling crypto at loss can sometimes be a good thing and not only offset capital gains, but also help reduce your overall capital gains tax rate if the losses are big enough to drive down your adjusted gross income. When assets are intentionally sold at a loss, this is often part of a strategy referred to as tax loss harvesting. Tax loss harvesting involves selling an asset at a loss, replacing it with a similar asset or investment, and then using the loss to offset any realized capital gains. With stocks and securities, The IRS prohibits investors from selling an asset at a loss and then immediately repurchasing it just to claim a capital loss on the initial purchase. And this is what they call a wash sale. In fact, IRS rules state that in order to avoid creating a wash sale, an investor must wait at least 30 days before repurchasing the asset that was sold for a loss. If one does engage in a wash sale, he or she can even incur hefty penalties from the IRS. However, the wash sale rule does not apply to cryptocurrency, at least not yet. This is because the SEC has argued that cryptocurrencies are commodities and not securities, and the IRS treats crypto as property. So let's dig a little deeper into this. Let's take a peek at how crypto tax loss harvesting in a wash sale might look like. So Jim made a killing with a few altcoins during the first half of the year and decided to convert some of those alts into one Bitcoin when Bitcoin was near the top and priced at $60,000. During the conversion, Jim realized a capital gain of $30,000. A couple of months later, though, Bitcoin crashed all the way down to $30,000. Now, Jim, being the smart, savvy investor he is, recognizes an opportunity and sells his one Bitcoin at $30,000. And in doing so, incurs a capital loss of $30,000. Of course, this $30,000 loss offsets his $30,000 capital gain he had when he converted his altcoins to BTC, meaning that he has no tax liability on the original conversion. A day or two later, Jim buys one BTC again at a price near the one he sold at, which was $30,000, of course. And if he buys back at 29K or 39,000 or 32,000, it doesn't really matter. Because Jim still believes Bitcoin will go significantly higher, he is still able to capitalize on a BTC rebound if and when it happens. So basically, he sold it at $30,000 and he's going to try to buy it back relatively soon, a day or two later, when it's close to $30,000 again. So there are risks, though, and it can be forbidden in a way. So let's talk about that. While the loophole for crypto wash sales exists today, that's as of June 1, 2021, when I'm recording this video, there is no guarantee that it will be an option in the future. The IRS and regulators could change their tune on crypto wash sales at any time. Still, it's highly unlikely that transactions that occurred before any rule change would be overturned. Nevertheless, you should also exercise a modicum of caution when taking advantage of the crypto wash sale loophole. Any transaction you make still needs to have some economic substance to it, meaning that as an investor, you should still bear at least some risk of loss. In short, there must be at least a small gap in time between when you sell the crypto and when you buy it back. If not, the IRS could deem the whole deal a sham transaction, and then they're just going to slam you with penalties. Still, most tax and investment professionals say that even waiting only a day or two is more than sufficient, especially if the crypto price drops a bit. But if it starts taking off and you buy it back, then you can say, well, I bought the breakout or I bought the dip, whichever way you prefer. Let's move on. Now let's talk a little bit about crypto tax record keeping. Investing in crypto requires meticulous record keeping in order to avoid paying too much in taxes. You can choose to do this by hand with a spreadsheet. However, using the automated tools from your exchange or a portfolio tracking app can save you tons of time and help you avoid typos and common math errors. So let's take a look at a couple of options for record keeping. Manual record keeping. If you only engage in a few crypto transactions, it's possible to handle all of the record keeping for your trades manually with a simple spreadsheet. Although I do recommend using the reporting tools from any centralized exchanges you might use. There are some decentralized exchanges that might not offer such options. So when you do have to keep track of trades, or trade details manually, you'll want to create a spreadsheet that contains, at a minimum, the data shown in the example below. So of course, you always want the date of the trade, the coin you're purchasing or selling. You want to show if it's a buy or a sell transaction, the price you paid or the amount of crypto you're selling, the quantity of the coins, of course, any fees that are involved, the total, and how you paid or what you received. For instance, if you're buying USDT and you pay with your credit card, you would enter the appropriate details. And if you sell, you want to make sure if you're buying like Harmony One, the coin you buy is Harmony One, and you paid with USDT that you bought with your credit card earlier. So now let's go on to the next option. And the next option is to simply export your transactions from your exchange. If you use a centralized exchange like Binance, Coinbase, Kraken, or any other major exchange, you can download transaction reports in CSV or comma separated value format and then import them directly into Excel, Google Sheets, and many other spreadsheet applications. These report files contain all the information you'll need to calculate cost basis and profits and losses. If you look on your exchange, there should be something for order history, trade history, or transaction history, or some sort of page like that. You should then see an option to download reports, download CSV, or something similar. And here is export order history from Binance. That'll appear a little different on each exchange, but it should be relatively easy to find in your history pages. Now let's move on to the next one. Portfolio tracking apps and sites. By far, the easiest way to keep track of your crypto transactions is to use a portfolio tracking app or website. Sites like Coinly or CryptoTrader.tax or Cointing.com, TokenTax, and a few others make it really easy to connect to your exchange or exchanges and download and sync all your transactions. To set up automatic syncing with your exchange, though, you'll first need to enable APIs on your exchanges. So somewhere in your account settings, you should see an option to enable APIs. On the API page, you should see the API key and secret needed to connect the tracking app or website. And again, this example is from Binance, and of course I've blurred out my API key and my account name up here. But once you have this, the key and the secret key, you can use it to enter into the portfolio tracking app or website to start syncing your transactions from your exchanges. Once you enter your API key and secret in the portfolio tracking app or site, it may take a few minutes to sync all your transactions, depending on how many you have. If you only have a few, it should take only a few seconds or a couple of minutes. But if you have quite a few, like hundreds, or you've been trading on that exchange for a long time, it may take up to an hour or so. If the tracking app doesn't support an exchange that you use, you should be able to upload a CSV file that you download from the exchange to sync your transactions. If you do use multiple exchanges, you'll need to sync or upload CS files for each. So for each exchange you do use, you'll need to either sync them or upload a CSV file for each one individually. Once you finish, though, all your transactions appear in a nice, easy to read format. Now, I'm not going to display all my transactions, of course, but here's a deposit I made on Binance not too long ago. But let's move on. Now let's talk about doing crypto taxes yourself. If you only have a few crypto transactions, and you're kind of person who likes to break out the pencil and a calculator, you might be interested in preparing your crypto taxes yourself. I do, however, strongly suggest that you use one of the crypto tax services that we'll cover in the next section. And some of them are even free for a limited number of transactions. So if you only make a couple of trades a year, this is something you definitely want to check out as one of these free services. And they work quite well. Still, if you do want to do your crypto taxes yourself, be sure that you have all the required transaction data available. And again, If you go back to that sample spreadsheet I showed you a couple of minutes ago, you'll at a minimum need that information. And then after you have that information, make sure you have the following forms available. Of course, your Form 1040, you'll probably need a Schedule 1 or additional income and adjustments to income, a Form 8949, sales and other disposition of capital assets. You'll need a Schedule A for itemized deductions if you donate crypto to a charity, and a Schedule B, interest and ordinary dividends, for reporting staking rewards or crypto earned through lending on a DeFi platform. Then, of course, Schedule D for capital gains and losses. And if you are running a mining business or something similar to that, you'll need Schedule C, profit or loss from a business. And if you receive crypto as wages or salary, make sure you have the W-2 from your employer. Using a crypto tax service, the easiest way, and I do mean the very easiest way to do your crypto taxes, is to use an online service or app. Sites like Coinly, Token Tax, CryptoTrader.tax, and Accounting.com, yeah, they're the same ones I just talked about in the portfolio tracker section, make it incredibly easy to import all your transactions and then create all the forms you're going to need with just a few clicks. Accounting.com and Coinly even offer free accounts for traders with a limited number of crypto transactions. So Accounting.com and Coinly not only allow you to track your crypto if you don't have many transactions for free, you can also generate your tax forms for free. So if you only make a few trades a year, you should definitely check these sites out. For heavier volume investors and traders, all of the sites I mentioned above do an outstanding job of providing you with an easy-to-use interface and IRS-approved forms with accurate tax calculations. Links to all of the services can be found in the Crypto Tax Resources section of this video, and I'll make sure to put the links to these services in the video description below. Now let's talk about a few things that we may not have touched on. So some other important crypto tax tips. IRS rules and regulations regarding crypto are changing all the time. The IRS is just now really starting to get serious about crypto, and they want their share. Therefore, you should try to keep up with changes before they occur. So any news you see about crypto taxes, make sure you read it. Just try to stay informed about any crypto tax changes that are coming. This will help you avoid any possible penalties and or problems in the future. Now, we touched on this a little bit, but I want to mention it again. Choosing when to actually take possession of mining or staking rewards and move them to your wallet can make a difference on how much tax you may owe during a particular tax year. For instance, if you already have a lot of income, regular or capital gains, and are nearing the end of the year, deferring the acceptance of staking or mining rewards until the following year could help reduce your tax liability. You don't actually have control of the reward tokens until you deposit them in your wallet. And until you have control of them, you don't owe any taxes on them. Don't forget that many states have income or capital gains taxes as well. So if you live in one of these states, you will need to file the necessary tax forms and pay appropriate crypto taxes. If you invest heavily into crypto and are making some serious profits, moving to a state without an income tax could save you a considerable amount of money. When possible, always offset capital gains with capital losses for maximum tax savings. If you don't really need the cash immediately, wait to sell your crypto in a low income tax year. And finally, consider becoming a hodler. Holding your crypto for at least 1 year always results in huge tax savings versus selling fast and incurring high short-term capital gains tax rates. So if possible, always hold your crypto for longer than a year. Now I'm going to mention a few crypto tax resources, and all of the links for these resources will be in the video description below. For general tax information, I recommend you view the IRS's Ask Questions on virtual currency transactions. I guess that should be frequently asked questions. Sorry for the typo. Another excellent site for general and very specific, actually, crypto tax information is Token Tax. They have tons of really good articles and blog posts about crypto taxes. And in fact, I relied on them heavily for a lot of information in creating this video. Now, as I mentioned, the crypto portfolio tracking and tax reporting apps and sites that I recommend are coining.com, Coinly, Token Tax, and CryptoTrader.tax. Now, they do vary in price, and their interfaces are slightly different, so you may want to check them out first before deciding which one you want to use. I don't really want to recommend one over the other because they're all pretty good. And if you need crypto tax information for other countries like the UK or Australia or Canada, like I mentioned at the beginning of this video, the information in this video is geared primarily towards US investors and US based investors. So everything in this video might not apply to you, but you can find really good crypto tax information if you live in a different country on CoinTracker and Coinly. So let's summarize. Selling crypto or converting it to another cryptocurrency is taxable as capital gains. Crypto collected through mining, staking, and lending is taxable as ordinary or interest income. Crypto received as wages or salary is taxable as ordinary income. Making purchases with appreciated crypto or crypto that is increased in value is taxable as capital gains. Receiving crypto as a gift is not taxable until you sell it or convert it to another cryptocurrency. Then it's taxable as capital gains if it appreciated in value. Buying or holding cryptocurrency is not taxable. Neither is moving crypto from one wallet to another. Gifting crypto to someone is not taxable, up to $15,000 per person, but is also not deductible as an expense or other type of deduction. Donating crypto to a charity can greatly reduce your tax liabilities. Transaction fees are not deductible as itemized expenses. However, they can be added or subtracted from purchases and sales to adjust acquisition and disposition costs. And finally, currently, only two cost basis methods are allowed by the IRS: first in, first out, and specific identification. Now it's time to wrap it up. I know this has been really long, but for any of you that follow my channel, you know I have a serious love affair with crypto. So this video has been a tremendous labor of love, and it did require, I don't know, countless hours of research and preparation. And I hope that, at least in some small way, it has helped you better understand crypto taxes. I've tried my best to cover the most important aspects of crypto taxes and how they affect everyday investors. However, it's still likely that I may have left something out. If I did leave something out, please let me know in the comments, and I will consider making another video to cover anything missed. Finally, if you did find this video helpful and informative, I do, once again, ask that you please like, please subscribe, and please share. Doing so would be greatly appreciated. So, once again, thank you so much for taking the time to watch this video. I really do appreciate it. So for now, this is Captain Crypto signing out. Peace and love. Bye-bye.